It's time for Physician Family Finances, the show where physician moms and dads like you can get the answers and encouragement you need to turn a good earned income into great life outcomes for tomorrow and today.
Hello, physician moms and dads. I'm Reineke, certified financial planner and primary advisor.
And I am Chelsea Jones, also a certified financial planner and primary advisor here at Physician Family Financial Advisors.
Chelsea, we have some interesting questions today. We were just talking before we clicked record, and a lot of these require a lot of nuance. And so, what you'll hear from any decent financial advisor is them hedging what they're saying before giving some big blanket advice, which you might hear that. Our listeners might hear that today. But I think they're really good questions. And hearing Chelsea and I talk about them may not feel like we're giving you a very specific answer, but that's because it matters. Your situation, your specific instance matters when answering these questions. So we're going to do our best. We like to kind of live in the average physician world, not even average, but maybe our average client's world, where they are high income, but sometimes not ultra high income. Or meaning they make $500,000 a year, but maybe not $1 million. But some of these questions are coming from physicians making in that $1 million range, and so we're going to try to speak to them and then scale it back potentially. I think that's my goal. We'll see if we accomplish it. Yeah. But these are also aimed at Chelsea's specialty. She's retirement planning specialist. So I'm going to read the questions today. I'm going to try to answer 2 of them, even though Chelsea's probably best to answer all of them. Okay. You ready?
Ready.
All right, let's do it. A gastroenterologist in Washington says, as I get closer to retirement, I'm realizing that spending down my investments is very different from building them up. What are the most important things to focus on with retirement right around the corner? And I just want to say, before you answer this is a very common thing we hear. Many people will build and build, and they're just accumulate. We call this accumulation phase. They're accumulating assets for about 30 years, and then one day, boom, no more accumulation, and they're kind of lost. It's been decades of doing the same thing, which is just save a whole bunch of money and invest appropriately. So, what are the things that you see that are kind of forgotten about or are misunderstood, I guess, when people are entering retirement?
Yeah. I think I've talked about this before. The most important thing that you need to know as you're entering retirement, you're going to start taking money out of your accounts that you've saved in for 30 plus years. You need to know how much you need. Mm-hmm. You don't just, you don't want any surprises when it comes to withdrawals. You don't want to take out too much. And you don't want to take out too little and not have enough to cover your bills and have to go take out more. That can be kind of hard to stomach, like psychologically maybe. But
yeah, because you're doing some planning that kind of hinges on how much you're going to spend. So, I mean, we could go into a million examples of this, but one might be, you convert some pre-tax money to Roth, but that is after you spend money. Like you have to determine how much you're going to spend, because you don't want to convert so much money that you push yourself into a higher tax bracket. You want to keep yourself below a good tax bracket. So there's some planning involved here, but you can only plan as well as you know you're spending in retirement.
Exactly.
Okay, I gotcha. All right, what's the next thing?
Yep. The next one, you kind of touched on it. You need a good CPA, especially if we're doing something like those Roth conversion strategies. You need to know how far you are into whatever tax bracket you're in, so that way we know how much Roth conversions you can do. All of my retired clients, I work very closely with their CPA every year because I'm very careful about this. We're trying to manage the tax bill, and we don't want accidentally cause you to pay more taxes than intended. And so having a really good relationship with a trusted tax preparer, CPA, is really important. Um, you also need to know your risk tolerance, because kind of in the same vein, it's different taking money out. It's also different uh, to sustain movements in the market and watch your portfolio go up or down when
Hmm.
you're taking money out. It's a different level of um, like involvement maybe
Yeah.
whenever you're watching your account balances as you know you need to take money out,
Hmm.
compared to when you're working, you see a dip in the market, you're like, well, you know, it'll probably rebound by the time I retire.
Yeah. When you're working, a dip in the market could almost be looked at as an opportunity. But when you're retired, a dip in the market looks like, oh my gosh, is this going to impact the way I live my life for the next 30 years?
Yeah.
Yeah, be very careful about this. We were just, and this touches on asset allocation. Chelsea and I were also discussing before this episode, we might need to do a whole episode on asset allocation. It is sort of one of those things that is taken for granted. You're just
Yeah, and
like,
kind of
oh,
slept on a little bit
yeah,
sometimes.
I'm
Yeah.
90/10, I'm 60/40, whatever. Well, it's really not. I mean, like, there's a lot of people are really confident that the stock market will just do fantastic forever. They don't really think much about it. They just want to take a whole bunch of risk. And you see this a lot more often in that you work with, retired physicians. That's not their attitude.
Mhm.
They actually care about what the stock market is doing and they want to take the appropriate amount of risk. So if you're going to learn from your elders, all our listeners, if you're going to learn from your elders through Chelsea, it is to care about this, because when you have money where it really matters, um, you can lose 10% in a portfolio, but if you only have 100 grand, you lost 10 grand. You lost 10 grand. It's not the end of the world. But when you have $5 million, you lose 10%. That stings. It's hard to stomach. Yeah, risk tolerance. Probably just like uh, risk tolerance is how much you can stomach, right? But it's also how much your plan can withhold,
Yeah.
like withstand. So that's a big one. How do you go about setting that for people? Do you let the plan do the talking, or are they kind of chiming in about how much risk they want to take?
So the plan does, it's a little bit of both. I would
Hmm.
say mostly the plan does the talking, because the plan gives context on like what is the actual effect of a drop in the market, and
Hmm.
it informs that conversation of how much can I actually stomach. Whereas if I just cold, like straight out cold asked how much can you stomach, the answer might be a little bit different without the context of the plan.
Of course. Yeah.
So usually we're planners here. I should get my kombucha.
Yeah.
Gonna go to the plan first, um, and kind of inform that risk tolerance conversation. And again, it goes back to knowing how much you need to spend. If you know your baseline necessity expenses are like, you know, $10,000 a month, but right now we're planning for you to spend 15, there's a little bit of wiggle room. And so that also informs the risk tolerance conversation. It's very case by case. Risk tolerance is something that's um, it can be kind of intimate. It's different for every person.
Yeah.
So, yeah. And then the last thing I would say about kind of what to focus on in retirement is there's a little bit of being opportunistic, especially in the early years. So, again, pre RMD age, post retirement, there's some
Mm.
opportunities to utilize low tax brackets while you have them. Um, so just looking at those, uh, taking a big picture look at everything and making sure that we're taking advantage of strategies that are going to benefit you in the long run.
Got it. Okay, that leads us into the next question a bit, I think. So, utilizing low tax brackets, we'll intentionally keep that vague because we're going to get into a little bit more here. Um, so, this is from a neurosurgeon in New York. If I am at the top marginal tax bracket now and intend on spending enough in retirement that would keep me at the highest tax bracket, then should I still contribute to a pre-tax 401k? So, uh, debate continues.
Mm-hmm.
This is our 153rd episode, and yet we still get the question of should we do pre-tax or should we do Roth contributions? Now,
Mm-hmm.
I just want to be real clear here. Like, it's not always a foregone conclusion. Like I have yet to find the case where physicians shouldn't be contributing pre-tax, but this is actually a reasonable question, I would say. It's like they're saying, hey, we make a lot, we spend a lot. We're going to spend enough where I feel like we're going to be our income tax rate is going to be really high in retirement as well. So
Mm-hmm.
I get it. You want me to save taxes this year, but if I'm going to pay 50% in taxes anyways, why not pay it now and let it grow tax free? And I asked you this as if like I didn't know the answer before the podcast, and you had a really solid answer. This is you got this question, and funny enough, I got this question about a week later. So this
Oh,
is
nice.
anytime this happens, I know there's some blog out there
Yeah,
that's like
something circulating.
something. But remember, this is unique to everybody, and it is also unique to people who are actually following a plan, who are doing
Mm-hmm.
actual planning. That might be different for you as someone who has a plan, who has a planner, versus somebody who is DIYing this and doesn't really understand the reason you would want this money in pre-tax accounts. So you have the floor. Should they contribute to Roth or a pre-tax 401k, even if they're big spenders in retirement?
Mm-hmm. Yeah. So this really all comes down to opportunity cost. Um, I think it's clear it's expensive to get money into a Roth account because you have to pay taxes on that money first.
A lot of
Um,
taxes.
yeah, because it's coming off the top slice of your income.
Mm-hmm.
The money that's going into your 401k is taxed at your highest marginal rate.
Right.
And so, um, for this family in New York, they're at the highest marginal federal rate. They're in one of the higher New York rates. And so they're paying 50% in taxes to get money into the Roth. And the opportunity cost there, Roth sounds really good because tax free growth sounds really good. But people forget that they're kind of paying money to get it into the Roth. If we if we want to do an apples to apples comparison, we have to consider those tax dollars that you're paying in order to get the money into the Roth.
Mm-hmm.
You could, you could invest the tax dollars that you would have paid putting money into the Roth and have, your pre-tax money going in and the, you know, $12,000 you saved in taxes by putting money into the pre-tax account. You can
Mm-hmm.
invest that, and now you've got money growing in two places.
Right. That's the biggest
So,
thing everybody misses. I've
yeah.
discussed. I mean, I feel like I have given this answer several times, but you can technically save 30% more money, or 40 or fifty
Hmm.
percent more money, because if you took the savings and invested it, you would have, instead of 24,000, let's say you'd have, forty thousand
Yeah.
dollars growing. But doctors don't think like that because they're already investing the extra money,
Hmm. Yeah.
because they have a plan that you or I wrote for them that says you also need to save $10,000 a month in a brokerage account. So it just doesn't quite.
Hmm.
They're thinking about two different things. One is taxes, and the other is um, just what's required to save for the plan. So
Yeah.
it when you compare apples to apples here, the race is a lot closer.
Hmm.
You know. Okay. In fact, it's a lot better for pre-tax. Because
Yeah.
not only do you get the tax break, but you have more money to invest.
Yeah. So that's kind of the opportunity cost to consider now when you're making the contribution. But also making Roth contributions now kind of takes away some opportunities for strategic planning in retirement, like we talked about
Yes.
in the last question. Um, so, and one thing I want to talk about too, in retirement, your money is coming out of different accounts. It's not just your
That's right.
401k that you're taking money out of. So even if you're spending, $350,000 a year, a good chunk of that is going to be coming from your taxable account. And your taxable account is when you take money out, part of it's going to be a return of basis. It's not going to be taxed at all. And part of it is going to be taxed as capital gains, which have preferential rates. Right now, the
Mm-hmm.
highest rate is 20%. Um, and so when people are expecting to spend a lot in retirement, that doesn't automatically mean that you're going to be in a high earned income,
Earned
like
income.
regular, yeah,
Yeah.
tax
This is
bracket.
this is the key. And this is because honestly, Chelsea, I mean, this sounds, I don't even know if I should say this, but when someone asked me this question, I thought, that sounds good. That
Yeah.
doesn't sound all that bad. And certified financial planner brain turned off for a second. And I'm like, wait a minute, hold on. Okay, so there's different buckets of accounts. Like, I
Hmm.
shouldn't call them buckets. There's different accounts that have different profiles for how they're taxed.
Yeah.
And if you're doing this the right way, you're going to be pulling from different ones at different times. Um, and what you're saying as well, I think you're about to get to this, is you're going to convert some of this money to Roth in the early years before you have RMDs coming out of your traditional accounts. So you take that 401k, you put it in an IRA. It's traditional. In the early years, you're not forced to take any money out. So you're converting a lot of that money into Roth anyways. So let's say
Hmm.
you're 10 years out and you're asking this question, or 15 years out. You're not talking about money growing in a traditional IRA account for 40 years. Talking about it
Yeah.
growing in it for 15 years, and then a lot of it growing in a Roth
The
IRA
Roth.
for
Yeah.
another 30
And
years.
yeah. And instead of paying 50% to get into the Roth, you're paying 24.
So again, if it was as easy as A versus B for the next 50 years, $1 in a Roth, $1 in a traditional for the next 40 years, of course the Roth is going to win.
Yeah.
But hold on. What about taxes? Hold on. What about investing the money that you saved? Okay, now it's like $1.50 versus a dollar. Okay, but hold on. But later on, we're also going to convert some of that dollar into Roth.
Hmm.
It goes way beyond this. So this is a very good question. It's too simple. It's just
Yeah.
too simplistic. And you have to be careful when you get into this because some people, most people aren't like you as a physician who makes $1
Hmm.
million bucks a year. That's the person, roughly who asked this question. And other people, let's say you're talking to someone who makes 100 grand a year. Okay. They're already in a low tax bracket and they have to work longer and they probably will spend the same exact amount of money in retirement as they do uh, when they're working. And they probably won't be able to retire until their RMD age actually hits. So it's just, you need a plan. Get out your kombucha. You need a plan. And this is a cool question. But at the end of the day, like you need a plan and you need a planner.
Hmm.
Yeah.
Yeah.
Is there anything else? I got excited there.
Yeah, I think the last thing I would mention too, another opportunity in the future for having money in a pre-tax account is qualified charitable distributions. So
Mm-hmm.
if you're charitably inclined, you're going to be donating money to whatever cause you're passionate about, even when you're retired. Um, Having money in a pre-tax account allows you to not pay taxes on the money at all. Give away your RMD essentially, because qualified charitable distributions, it's taking money out of your IRA. That distribution can satisfy all or part of your RMD. So you get a benefit there too. Um, and then you give it to your charity. You don't owe taxes on it because you're donating it. And the QCD is actually more beneficial than taking money out of your taxable account to give cash to a charity because you have to pay capital gains to liquidate the cash, and then you get a deduction whenever you file your taxes. And so, yeah, that's another opportunity that you
Yeah.
have with pre-tax accounts that you don't have with with Roths,
with going straight
where
to Roth. Yeah.
yeah.
You're just locking in this 50, you're going to pay 50%. We're calling it 50%, New York, and
Hmm.
40% in federal. You're locking in, you're paying 50% guaranteed.
Hmm.
And, we always get
Guaranteed.
well, what if tax rates go up? Well, yeah. What if? What
Yeah.
we can tell you
We could
right
what if all
now,
day.
what I can tell you right now is you're paying 50%.
Yeah.
So it's a cool question. It made us think. It made us think that it deserves a good explanation. Anytime you get a question like this and the underlying assumptions are just not clear, that's, I feel like, on us. Oh, let's put it on the podcast and like flesh it out so that people feel good about getting this tax break. The amount of times I have had to negotiate with a physician about saving money on taxes in this way is kind of funny. But what that kind of means is that we're not explaining it well enough to get excited about the break you're getting. Okay. Next question is from an anesthesiologist in California. When should I take Social Security? I have always assumed age 70, but are there benefits to taking it earlier? Okay. So I'm going to make this simple. You could get more complicated with it. But at the end of the day, this is another one of those things, by the way. If you grew up around middle class people, they always say, wait until I'm 70. I'm trying to get there. Because there's this assumption that you get more money if because you do. Your benefit is larger. So that's where this
Hmm.
question stems from.
Yeah.
Here's the thing, okay? The government doesn't care when you take the money. So you have to ask yourself, why don't they care? Because they could make you take it at
Yeah.
67.
I mean, why give you the option
Why?
at all?
It's complicated. Why not just start sending checks at 65? The answer is because it doesn't make a difference to them. Okay. And this is the same with things like annuities. There is a company, they're life insurance companies or actuaries that are very good at knowing when everyone's going to die. And so if they know on average, let's just say, I don't even know what the average, I mean, we don't know how long people are going to live, with modern technology, but let's just say the average person's dying at 85. All they're saying, if you take it out at 65, 67, 70, whatever age you decide to take it out, all they're saying is you waited long, didn't take part of your benefit. We already think you're going to die at 85. So
Hmm.
we're just going to give you more when you're 70 because you waited longer.
Yeah.
We need to give you your full benefit, but they just assume you're going to die at a certain age. So if you knew when you were going to die, then you could game the system. You could say, I'm going to wait till I'm 70 because I know I'm going to die at 100. So I'm going to squeeze all the extra juice out of this thing. But since you don't know when you're going to die, Chelsea always tells people, take it when you need it. Right?
Hmm.
If your life expectancy is lower, if you just know, we have some clients where their grandparents and their parents died, let's say in their late 70s.
Hmm.
And so if that's the case, then you would probably want to take it earlier because even though the benefit amount, the amount you actually get is lower, you get it for more years.
Yeah.
But for most people, we just don't know. And therefore, just take it when you need it and don't worry too much about it. At the end of the day, there's not a whole lot to game here. Now, what's funny is people always want to see in their plan which one they should choose, but it actually doesn't represent the real decision when you put it in a financial plan, because in a financial plan it always assumes that you're going to die in your 90s, or
Yeah.
some financial planners will write it out to 100. The reason we write the plans out so far is so that you don't run out of money. We don't want to write it till 85 and then you live to 95 and you run out of money. But if you write in the plan that it's going to go till 95, then that's a strong assumption to be made about Social Security.
Yeah. Of course, the plan's going to say 70.
Of course, because you live till 103
Hmm.
years old in your plan and you want to wait as
Yeah.
long as you can, but that's not the case. So we always just put it right in the middle in our plan. We just say like 67, and that just is what it is. But it's a funny question. I hear it all the time still. Even family members are like, I'm waiting until 70. I'm just like, I won't say anything. It's you wanted to point this out too. A lot of people are trying to speed to Social Security so that because they feel like it's going to go away. I think we have a pretty strong stance here that Social Security won't go away, mainly because it would be political suicide to do so. But also, if we just took it really seriously, we could fund Social Security.
Yeah.
There's lots of things in our government that go unsolved, underfunded, because whatever administration is in office at the time does not want it to be their administration that spends too much on something. Or, I heard something the other day that our government's technology systems are really poor, like they're not updated, and it's
I
because
mean,
nobody.
anybody who's been on a government
Yes,
website can tell that.
right. But and it's like, well, why don't they fix it? Well, because nobody wants it on their balance sheet. They want the
Yeah.
next person to do it. Well, it's the same with Social Security. Nobody wants on their watch to eliminate Social Security. That would be crazy. They wouldn't get reelected. So it's an interesting question politically to look at it, but I just don't see a world where Social Security goes away entirely. I wouldn't make my decision based on. Okay, I thought I was going to answer that quickly, but I didn't. Dermatologist in Texas. What if we put most of our money in stocks, but just keep a few years of cash on the side so we don't have to sell when the market is down? Does that actually make things safer? So, a little bit of context here. Um, this dermatologist in Texas has far more money than they need to retire. Okay, they've done a fantastic job saving. They're super savers. They still spend a decent amount, more than the average family, but they've made more than the average physician for many, many years, and they did a great job saving. So when I wrote their plan, I said, hey, it's time to consider, taking some risk off the table. They were about 90% stocks, and they're 5 years out from retirement. And we agreed on going 70-30, I think it was. Well, I think that there was some regret a little bit. Only they could tell you exactly why, that they were regretting it, because obviously they had plenty of money to retire, but there was just a little bit of regret, like, well, maybe I'm leaving some gains on the table by going 70-30. And so the question was, well, what if I just took out a few years of cash so that I could stay 90-10? And I understand the sentiment. This is another one of those, it's very unique to you, whether or not this is a good idea or not. Most of the time, I think that it can be solved in a much more straightforward way. But what this is addressing is a sequence of returns risk, which is that when you first retire, there's a risk that you now have that you will start withdrawing money, selling your stocks as the stock market is going down, which makes it very difficult if you're on the edge of being ready for retirement. Experiencing that type of drawdown at the very beginning of your retirement makes things difficult. But here's the thing. So there's a couple things as I was thinking about this question. One, we know about the asset class of cash, right? Inflation, destroys your cash. And so to have money in cash, 3 years worth, 5 years worth, a lot of times people talk about 5 years worth, that could be $1 million. 5 years worth, it's $1 million in cash.
Yeah.
So the question is it safer to put money in cash, 5 years worth of cash, so that I can stay aggressive with the rest of my money? That doesn't really, when you really think about it, doesn't make a lot of sense. All you would need to do is just not be 90-10. Like, let's say you go 80-20. So instead of being 70-30 and wanting to be 90-10 and taking money out in cash, just look at it as I need 5 years at least worth of money in bonds and cash, and keep it a part of your portfolio, because at least bonds will keep up better with inflation than cash will.
Yeah.
So I don't
Not to
think it's
mention $1 million in a bank account, in a single bank account, is above FDIC insurance
yeah,
levels. So,
we already got problems. Yeah. No, it's interesting, for this particular person, he has saved plenty of money to where if he was 90-10 or 80-20, there would be enough money in bonds. So technically, this doesn't solve any problems, because if you
mhm,
have that sum of money and being 90-10, while it feels really aggressive, which it is, but 10% of money is, 6-7 years worth of your expenses.
yeah,
You have a lot of capacity for risk. Your
mhm,
portfolio has the capacity. What we're discussing when we say go 70-30 is not your portfolio's capacity. It is your
your
capacity,
capacity.
your stomach's capacity for this.
Hmm.
And it comes back to the, something we should address on a different day, which is this very overconfidence in the market right now. Everybody is very
Hmm.
confident. Why wouldn't you be? Most of the people we're talking to, they have never seen a down market,
Yeah.
right?
Or they didn't
They've
have
been
much money during the last
right.
down market.
Or the last down market, they had, under $1 million. Um,
Hmm.
but most people who have been investing since, let's say, for the last 15 years, not very many like major bear markets, and
Hmm.
so they just don't want to miss out. But this
Yeah.
is something that's unique to everybody. You should talk about this with somebody else. You shouldn't just hear me say this and make your decision on your own. This is asset allocation, what to do with your money, how to invest it. I think that's a conversation that should be had with an advisor or a trusted person.
Absolutely.
So, yeah, I think at the end of the day, some of these unique little strategies, if you zoom out, maybe they're not necessary, but you just need to understand that when you're making decisions with investing, usually it's driven off of two feelings: it's fear or greed. But most of the time, we only think about fear, meaning I'm going to be
Hmm.
90-10 because I have the stomach for it. And they think that I'm not going to let fear get the best of me. Remains to be seen. But what you're actually also saying is um, there is an element of greed here, and that I don't need the money, but I still want to maximize the money. And
Hmm.
there's nothing wrong with either of those things. We all have both of those feelings as investors. But the big question is or big thing is to have someone to ask you why and be able to justify, why do you want to take that much risk? And is it worth it after you've justified it? Like, okay, now is it worth taking the risk?
Hmm.
Okay, that's it for today. Thank you everyone for listening. If you liked this episode, be sure to subscribe so you don't miss it when it comes out every Wednesday. And if you'd like to work with us, you can visit us at physicianfamily.com to schedule an interview. And if you're not ready for that, you can send us a question. Send us a question at podcast@physicianfamily.com. We will answer every single one of them, even if it doesn't make it on the show. Until next time, remember, you're not just making a living, you're making a life.
Are you ready to turn worries about taxes and investing into all the money you need for college and retirement? It's time to make a plan and get on track. To find out if we're a match, visit physicianfamily.com and click Get Started. Or you can ask a question of your own by emailing podcast@physicianfamily.com. See marketing disclosure at physicianfamily.com/disclosures.